Hey, hello, mic test, mic test, mic test. Can everybody hear me loud and clear? Okay, excellent. How are you doing, trader, member? Pretty crazy day today, huh? So that's what we're going to talk about. This, presentation day will be about an option strategy guide. So you get a lot of questions from my members about what I've kind of termed OSC, so option strategy confusion. So we're going to go through that today here and clarify, kind of how to look and set up the right strategy for the appropriate, market that you're trading. So it's I think it'll be a very helpful kind of workshop today for everybody. Yeah, it's hot here too. I'm here in Austin. It's about 102, so it's pretty toasty. Hey there, John. Looks like we've got a good group here. So does everybody here trade options? If you are, have traded options, and let's put it this way, if you're just starting out to trade options, why don't you put in a number one? So see how many people here are just kind of beginners. So if you're just starting to trade options, if you don't mind, put in number one. All right, well, thank you. So we've got a lot of folks here that have traded options and a bunch that have not. So got a good mix. Okay. Yeah, well, at TraderX, I'm not hosting this event. So I would just suggest sending an email or something, because I can't help you out on that. Sorry. You should be able. Can everybody else hear me loud and clear? Okay. So if you can't hear me, it's hold on one second. Okie dokie. All right, so if you can't hear, go out and come back in, because it looks like everything's good. All right, I think we're ready to go. So again, we've got a great crowd, and I certainly appreciate everybody being here tonight. So let's get started. So what we're going to talk about, and I'm going to get into here, is an option strategy guide as to when and how to use which strategy for the best results. So it kind of comes back to kind of this kind of term: do you ever suffer from OSC? So picking the right option strategy for the right environment you're trading, the right market cycle, it can get very confusing. So that's what we're going to address here tonight. So a little background on myself. I've been, actively trading, for over 40 years and started trading options, for over 30 years back in the 80s, back in the mid 80, 87. So I started trading, on the oil side. I was, started out my career trading oil cargoes and tanker cargoes and products and all that stuff. And eventually went to work at a company called Trans World Oil, which was the largest oil trading company actually in the world. And so it's Fibro, Mark Rich, and Trans World. So went to work for them back in the mid 80s, and then was there for about 17, 18 years and ran the international trading group out of Bermuda for 10 years. So that was a really fantastic experience. But that's where I first started trading options back right about 1987. So we were, trading options on cargoes of crude oil, Brent North Sea. And that's where I kind of got my passion and start in the options side, and just been kind of really passionate about it ever since. So that's a little touch on my background. So let's get started from there. So the following presentation here is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, to me, the secret to trading profits really come down to three things. And those three things, one second, is really direction. You have to have a good, you have to have a directional view of the markets and get that right. And you have to have good timing, which I call a timing edge. And then you want to manage your risk, through options and option spreads. So that's what we're going to be talking about, that kind of the option spread side of things here tonight. So, trading options has so many more great advantages than trading stocks, but can be confusing and debilitating to traders or investors unless you really know which option strategy to use and when, and then how to use it correctly. So that's based on the market environment you're trading. So I call this kind of debilitating trading dysfunction the option strategy confusion. So we've all, suffered from it from time to time, and I still do, but I put together a really good guide to help step you through the best option strategy for the right environment or market cycle that you're trading. All right, so let's start with that. So, the option strategy guide is what you're going to need to know to successfully trade options. So you want to get rid of that option strategy confusion that can really, kind of clutter your mind and make everything so uncertain as to what you should be doing in a certain situation that you're, trading. So first off, the first step though is you want to understand how option pricing works. So you want to do this in order to maximize your option trading profits and to select, the right option strategy based on, the option pricing and the option pricing model that we use for option trading. Now, when we look at the price of an option, it really comes down to the most important factor for options and understanding options, the concept of time and the concept of volatility and the impact that it has on your price of your option. So when we look at time, and time is what we can really look at and say, okay, it's basically the extrinsic value or the time value of your option. So it's the premium that a rational investor is going to be willing to pay over its current exercise value or intrinsic value based on this potential to increase in value before it expires. So the change in the value of an option based on this time decay, we can measure that using the Greek theta. So that's the other great thing with options. We have these Greeks that we can use, and so we can, use those to kind of tell us, what an option price is going to be worth, under different market circumstances and conditions. So we can use the theta to kind of tell us how much time is decaying or eroding each and every day. So time decay always is going to work against the buyer of an option, and it's going to benefit the seller. So option theta is going to have what we call either a positive or negative kind of characteristic or value to it. Now, when you look at long options, so if you're long a call or if you're long a put, they're going to always have what we call a negative theta value. So if that security that you're long, either a call or put on, if it goes kind of churn sideways and doesn't really go in the direction you want it to go, you're going to be losing value on that option. And at expiration, actually, it'll become worthless or go to zero. So it's a time decaying kind of asset. Now, the flip side of that is when you're short an option. So if you're short a call or if you're short a put, you're going to have positive theta value. So it's going to indicate that that position, even if you're going sideways, is gaining value each and every day. And that's a great thing that we can do with selling option strategies, which we're going to talk about, two really dynamic ones, actually a couple of them here today. So many option trading strategies will also sell out of the money options on top of just buying the at the money. So this is done in order to partially offset the negative theta decay component of the option. And also, it also is going to help to reduce the capital at risk. So it's going to lower a rate of time decay and lower capital at risk. And that's the thing that's so great about option spreads. We can do this, using a spread to take advantage of what I call the sell side components of an option. So when we look at, such spreads as maybe a vertical bull call debit spread, that's going to be you're buying a call but selling a higher price call. So that's going to help reduce that theta. That's going to help reduce that capital at risk. And then you've got the vertical bear put debit spread. So if you want to go, use a short trade setup, we can do that. And that will also make our capital at risk very low and also reduce our theta. Now, the other one that's super great, especially for the environment we're in now, where it's just high volatility and you don't know, one day to the next, it could really have a big movement, and we want to keep our risk super low, but also have good positive theta, is the butterfly spread. So probably out of all the different option strategies, option spreads, the butterfly spread will give you the highest return as far as on capital at risk. And we'll go through some examples here in a little bit. And then the other really great kind of spread is what we call the long condor. So that's another one that we can really structure to lower our capital at risk and also to control theta and give us positive theta, so we're not having that theta decay against the trade. Now, when we look at the other big pricing components, it's volatility. And the implied volatility component is expressed as a percentage of the stock price, indicating a 1 standard deviation move over the duration of the option cycle or series that you're trading. So in theory, a stock should end up, within about a 1 standard deviation of its original price, 68.2% of the time during its option cycle. So this theoretical probability or forecast of a security's price range should be, a part of your trading process used for selecting the highest probability price targets for your trade setups that you're taking. So this is one major step that we do on every trade before we ever put it on. We want to look at the implied volatility to help us give us an idea and theoretically forecast where price could go. So when it comes down then to pricing the value of an option, it's going to be that time component, time value, times the implied volatility times your underlying security value, which is made up of that intrinsic, extrinsic value. And then once you know these variables, then you're ready to price out the option, know what its option premium should be, and then select the appropriate option strategy. Now, when we look at option pricing, I thought, this is a really nice little example to kind of show you how option pricing flows. So here, every Thursday, so for example, today, we'll have a brand new option series. Most option contracts or securities now will have weekly options, which makes it, ideal for all these different strategies we'll talk about today. But on Thursday, we have a brand new series that comes out. So on today's, Thursday, it comes out, we have 100% time. That's a new contract, so the time component is 100% in that option. Remember, time goes down each and every day. And so it's time value times the implied volatility. Okay, so that's what the market's kind of telling us the volatility of the market is. And when it goes up, implied volatility goes up, the price goes up. When it goes down, it goes down. So it's implied volatility times time times the underlying security value. So I'm going to leave this constant so you can just see how it flows with time times implied volatility. So 100% time times the first day we had, I just put in a number of 300. So you can see that the value of your option would be $300. Now you come back in on, let's say Monday right here, okay, after the weekend, so we're getting hit with time every day, even on holidays. Now we only have 50%, half the time value of that option left. So it's been cut in half. So put the value here, the implied volatility, up to 800. So even with the spike from from 300 to 800, you can see that the option value or price barely went up. It went up to $400. So, because the time component of the price has been cut in half. So let's say implied volatility then drops down, and right now then it was trading only at 200. So if it was trading at 200, then the price of your option would only be $100. So you can kind of see the flow, how it is. When option volatility goes up, that helps increase the price of an option. When the option volatility goes down, it also has an impact on decreasing the price of the option. And the big takeaway is that at the end of the day, at the end when it expires, whatever option series you're looking at, time goes to zero, and volatility goes to zero. So that's why when we do option spreads, we're going to have kind of a buy side component and a sell side component, which has the advantage of taking advantage of this, time decay and volatility, what we call collapse or decrease in the volatility. So that's what we'll talk about next as we go through some different trade setups and examples. Now, thing is, it's pretty cool about options is you can actually trade time. And how do you do that? So we can trade time by actually selling time to take advantage of that option time decay. So by selling time, we are in essence selling time, and we're also when we sell an option, we are also selling volatility. We're selling both of those pricing components. And the other way to really kind of look at an option to kind of make it more clear to you if you're just starting out is think of a coupon that you get at a store. You look at the coupon and it's got a redemption date. They'll tell you you'll get a certain kind of value from using this coupon, with whatever you're buying, but you have to use it by a certain date or else it's going to expire, worthless and you can't use it. Well, that's exactly how an option price is. We have the different option series and they're kind of finite. So once they're done, that option's worthless, like a coupon would be. So when you go out and you look at kind of the option pricing, let's say you go out 120 days or say 90 days out. So as you go further out in time, you're going to see very small amount of time decay. It's very, very small and gradual, very gradual. Now, but once you get 30 days out, especially 30 days out, that's when it really kicks in and starts to accelerate. And then we have the weekly options, and we have really great acceleration to the downside. And eventually it goes to zero. So if you're buying way out here, eventually, you're going to start out with a very, very little small time decay. But if you come back after a vacation, a long vacation, you still have that option on, you come back 30 days later, you're going to see that sucker really starting to tail off. And eventually, again, it's going to go to zero. So you have a finite period of time in which you can use that option to, make you money. So that's the key takeaway on this kind of graph. Now, the next thing, step 3, is, when we look at trading in general, it's all about probabilities. And that's the other great thing with options. We can really define the probabilities and use our option Greeks to help us with that and forecast price. So when we look at probabilities and options, the options are, prices are made with the market makers of the market. And it's kind of, it's their secret. What they would not like you to know is how the option pricing works. But that's what we're trying to clear up for you today, or I'm trying to clear up how the option price works. And this is kind of what I refer to as the market maker's secret. It's what they don't want you to really know. So when you look at the option markets, the option markets use mathematical market probability statistics for pricing the movement of an option to its expiration. So by knowing the probability of your underlying security or stock finishing within a certain price range at expiration becomes key to determining what options to buy or sell, and then which option strategy you should use. So these statistics forecast how likely it is that an option will fall within a certain option series price range, either up or down by its expiration. And this forecast of that price range up and down is what we refer to as the implied move of the stock, or you might hear it kind of talked about as the expected move. So this is what we can use to help forecast theoretical price range up and down based on an option series, based on the underlying security that you're trading, based on days to expiration and the volatility where it's at. So the implied move then is the estimate theoretically of what we call a plus or minus 1 standard deviation move over the underlying security by or to its expiration. So if you look at this, this diagram here, this is just what we call a normal distribution curve. And what kind of helps to kind of clarify, this kind of option statistics. So when we look at this, if you, take an option statistic 101, this is the top of the bell curve here. So we're looking at this distribution of data, and in this example, it's a distribution of price. So theoretically, when we look at options, we have what we call the option delta. And just a real simple way to think about delta, it's telling us the probability of an option reaching a certain price point. So for example, if we have, say, days to expiration in this example, we have 10 days for this options series, and then after 10 days, it expires worthless. So the market here is trading at the money at $500. Now we've got 10 days expiration, and we'll just say in this example, it's the expected implied move, which we're going to talk about, is for it to move up or down 4%. So if you take 4% times 500, that's going to be $20. So that's going to be our forecasted where price can go. So it could go up either $20 or it could go down $20 over the course of the next 10 days. So this is the implied expected move. Up is 20 and down is 20. And then the range, so that puts you down to 480 up to 520. And the range between those 2 points, that's 1 standard deviation. So it's theoretical, but this is what I kind of term as kind of a normal price movement. So let's say you had whatever it might be Apple, and you had your 10 days expiration expected move is 4% based on the implied volatility. So over the next 10 days, a normal realistic move would be that Apple could go up to 520 or down to 520 or down to 480. And the outside point here is what we call the option delta. Right here is 15.9. It's a kind of percentage of that range, but basically that's like a 16 delta. Okay, so this point here would be like a plus 16 delta, and the 480 would be like a minus 16 delta. So I usually refer to 16 or 20, just kind of keep it kind of approximate. Now the way it works is that one option contract's equivalent to 100 shares, and that's what a delta. And the max delta value would be 100, and so that's like 100 shares. So if you had a 16 delta, you take the 100 minus the 16, and that gives you your probability of price where that'll be. So in this example, let me erase this so you can see it more clearly. So in this example, if you sold that 520 strike right there that had that 16 delta, that give you the reciprocal is that you've got an 84% probability that price will be below 520 at expiration, if that's 10 days or 20 or whatever it is. Okay, so 84% probability that if you sold that 520 call, you're going to have you're going to go in with this as an 84% probability that the price would be below. And the other way around is if you were selling that 480 put, there's the 84% probability that price would be above 480. So those are things that we can use to kind of give us a price forecast of a theoretical normal move of whatever you're trading. And that's the first place that we start with any option trade, is what is that expected move or the implied move. So here's another example. So here's Apple, and it's trading here at $190. It's got 28 days to expiration on this 5 July series. And here's your implied volatility number right here. This thinkorswim is 29.13. And that's giving you this number here. It says plus or minus $12.39. So that's plus or minus $12.39. So that's your delta there. So basically, if you look here at the 190 strike, which is kind of at the money, it says a delta of 52. So just look at that as like, a 50-50, like flipping a coin. So there's a probability of about 50% it could close below 190, 50% it could close above 190. But when you look at the deltas going up, you can see that as you go up here, right here, so you go from, let's say, 190 to $202.50. You look over here at the delta, and you see it's giving you a 20 delta. So that is the way you can look at that with probabilities using options, is that you've only got about a 20% chance or probability for Apple to get to 202.50 over the next 28 days. Or the other way to look at it is the reciprocal. Here's what we call probability out of the money. So that's the 82.22% probability that price will be below that 202.50 using that 20 delta. And then let's take it the next step further is if you, let's say, look at the 215 strike, it has a 5 delta. That's like a 2 standard deviation price point. So there's only a 5% probability for price to get to 215, or the other way to look at it is reciprocal. There's a 95% probability that it will close below that number. Okay, it could come all the way up to that number. It could go over, but the probability by expiration is that the probability is only 5% to the upside. So that's what we use to plot out our potential expected move calculations for a stock or a security, whatever we're trading, using options to give us an idea where price could go. And if you relate this to that normal bell curve, it's like, you look at this would be like that kind of that 20 delta right here, like I said, a 16, 20 delta is kind of that outside price point there. And that's 1 standard deviation, okay? And then if you go way down here, that's like that, 3 to 5 delta right here. That'd be that point right there. And so that's what we're looking for to help us, give us that forecast of where price could go. Okay, so that's kind of hopefully an explanation that you understand there. Now, by using this probability analysis, it really provides us a very useful tool to determine price targets that we want to trade against. And it's very useful for then also setting hedges. So if we have the mathematical probabilities, for example, if we're looking at setting a hedge or something, you want it to be far enough away from where the market is so it doesn't hit that strike price. So if you look at that bell curve and let's say you're long something right here, but you want to set a hedge. So we want to go out that curve, and the further we go out, that hedge, we don't want the hedge to be hit, right? So if the market's trading here, we've got the hedge up here. That's how we can determine where to put that price point. So if we did the 16 delta, then we can relate that. That would be like in this example, 520. So let's say it's right here trading at 500, and we want to set a hedge. So the 16 delta, we'd have a hedge up here at 520. Okay, so there's a 20% chance that you can get there, but if we want to get even further, we can go further out and use that 5 delta, which would be like 540, and that's how we can kind of theoretically figure out where we want to set our hedge based on probabilities. So you can see that, based on the math of probabilities, you can see about, theoretically about 70% of options that are bought, especially if you're out of the money buying those options, they're going to, basically expire worthless. So it's a really good idea, for traders or investors to consider selling options just as well as just buying options. And so it's really easy when you're starting out. You just want to buy low, sell high. So, most beginners, that's all they know. So they either buy calls or they buy puts, but they don't really understand the negative part of that, just always going long. And the big, negative disadvantage is that option theta decay. So that's what we want to kind of, be aware of and be able to then flip the coin and take advantage of that. Okay. So when you combine these two, buying and selling options together, it creates really an unmatched option strategy that will provide you greater returns with a lot lower capital that you're risking in the market. And right now, that's really what you want. You always want low capital at risk, but especially right now. And over the lifetime that you're trading, that's going to really help you to win the race. So this is, if you're wanting to take advantage of options and the leverage, this is, what you really need to understand and learn first. Now, the next thing is selecting the perfect option strategy, and basically for the market environment or market cycle that you're trading. Now, it gets really confusing because there's so many different strategies or different option type things that you can do. There's the debit spreads, the credit spreads, there's bull put, there's so many that it really gets confusing. Which one do I use? Which one should I focus on? So that's why I came up with this presentation, is to kind of help to clarify, which option strategy to use, when, and how. So the process, kind of in summary breakdown, is okay. Is what you're trading? Is it going? What's going on? You want to identify the market cycle that you're in. So when I say market cycle, do you think the market, what you're looking at trading, is it going up? Is it going down? Or is it going sideways? Or you have no idea at all? Now, two, you want to identify your chart pattern. So what's really helpful, there might be certain patterns that you found that you like to trade that seem to be very successful, give you a lot of winners. So I put together 5 selective patterns that I use that offer me, potentially really good high probability kind of trade setups. So I look for these patterns, and that helps me then select what option strategy to use based on the 5 patterns. Then you want to select, okay, what is your time horizon? How much time do you need? What is your trade duration? When do you expect that trade to make money? Are you day trading? Do you want to, keep that risk low? So you're looking to making money today, tomorrow, or next week. So you need to look and focus. What is going to be the trade duration of your trade? You need to select and align that with the trade strategy that you set up. Then you want to look at, what is your capital at risk? What is your market condition? And that's going to dictate what type of risk you take. So are you in a really high extreme market volatility, or low, et cetera? So do you want low risk, medium risk, or are you good with high risk? But you want to know what is your risk, and that's going to be based on the market condition you're trading. So we want to quantify that. And then the objective is, are you looking more for revenue, for kind of a passive income, or are you looking just for, profits at all time, just to, to maximize your returns, et cetera? Are you looking for, hedging type strategies, or strategies that are going to be longer term to give you capital gains? So these are all things that you want to put into your process of selecting the correct strategy. Now, the option strategies and when to use them comes into the equation next, okay? So for me, kind of the go-to strategies that I'm constantly looking at might be just to use long calls or puts, looking at maybe using a vertical debit spread, so it could be on calls or puts, maybe using a vertical credit spread, the butterfly, fantastic, long condors, a really great strategy. And then there's really the income calendar, the double calendar, calendar diagonal. So these are all kind of the different ones that I've broken down that I'm constantly going back to. So over the course of the different cycles or different market environments, these are the kind of the option strategies that I tend to go to. So if you look at just the basics of it, what is a long call or put? So these can be used, for your day trades. Instead of just buying stock outright, you could just buy a call or put, depending on which direction you think the market's going to go. You can use these for swing trades. So those are kind of what I identify as trades that could last a day to 10 days or a little bit longer. Or you could use them for longer term trades. So generally, when you're looking at buying a call or a put going outright on that directional kind of move, I'll tend to use maybe something around a 50 delta, or go a little bit deeper in the money to also help reduce theta. So maybe a 70 delta. And then there's the vertical debit spread. So these can also be used, for your swing trades or longer term trend trades. They're a spread, so you're going to have very defined risk. You're going to have lower capital at risk than if you're just buying long calls or puts. And you're also going to help to offset some of that time decay or theta decay by, having that spread, so having a vertical debit spread or vertical, call debit spread or put debit spread. And then there's the ultimate credit spread, that's the vertical credit spread. And that can be used, also for day trades or swing trades. And it's better to use if you're, when implied volatility is high, because you get more premium to sell. Now, they're also defined risk, takes advantage of time decay, and great for sideways kind of price action markets. So we're not in a sideways market right now, but when we are in a range bound market, credit spreads are a great way to go. So if you look at just the dynamics, the ratio, the profile of a call debit spread, here's a good example. So if we look here at this example, this is a call debit spread. So basically, you're long a call, short a call. So right here, you can see 1,010. So you'd be long this call here, the 1,010, and then you'd be short against it to cap your upside risk, or downside risk, downside risk, I'm sorry. You'd be short against the 1020 right there. So you're long this call, short that call. Now, if you look at that, that's a $10 wide spread, right? So $10 would be then $1,000 wider. One option contracts equivalent to 100 shares. So it's a $1,000 wide spread. The cost of this trade, in this example, is $300. Okay, so that's your capital at risk, 300. So then your potential profit is the difference, which would be 700. So that would be your maximum profit if at expiration. Only at expiration would you get the max. So at expiration, if it closes at 1020 or above, you're going to keep $700, and that on your risk of 300 is a 233% return on that capital at risk. Or you can look at it this way: you're risking $1 to make $2.33. So you can see that the potential there is great. Plus, it's going to give you a lower amount of theta. So that's a vertical debit spread, a vertical call debit spread. Now, the other flip side of that is the vertical credit spread. In this example, vertical call credit spread. In this, your profit is only the credit that you receive. So not any more, not any more than just the credit received. So you can see that on the debit spread, you had a risk of 300, but you could make up to 700. Okay. On this trade, you've got a credit of $200. That's the max you can risk, right? Or max you can gain. And then your capital at risk is the difference. So again, this is like selling the short strike here, the 1020, and then buying the 1030 here, call to cap that risk. So in here, you can see it's $1,000 wide spread example as well, but you're getting or bringing in $200 credit. So your potential risk is the difference between that. So that would be your margin that you'd have to put up on that trade. And so your return then is just going to be based on that margin. So all you can make is $200 on that risk of 800. So that would be basically all you'd end up with be 25% return, or you're risking $4 to make $1. So most, when you're just starting out, you're saying, well, why would I do that? So these are basically what we call the probability trades. So basically, if you were to have sold that 20 delta that we talked about just a minute ago, you're basically starting that trade out with an 80% probability, theoretical probability that that's going to be a winning trade because price will be below that short strike here. Okay, so that's why you have a less return, because theoretically there's less risk. But that's not always the case, because sometimes we can blow right through there, as you probably know. Now, the really a great one and a favorite is the butterfly spread. It's a very unique strategy that combines both buying and selling options. So the vertical debit spread combined with a vertical credit spread is a defined risk trade, takes advantage of time decay and implied volatility decay or collapse, gives you positive theta, so there's no time decay, gives you big positive theta. Of all the different spreads, it gives you probably the most positive theta. I like to use it for directional, but it can be non-directional as well for swing trades. 1 to 2 weeks out is about as far out as I would maybe tend to go. When to use, if you have high return on capital, and it's going to give you very low defined risk. It gives you great leverage, but very defined low risk. Fantastic for hedging. So here would be like an example of what a butterfly looks like. You've got basically you can do this calls or puts. So if you're thinking upside, you do calls. Downside, you do puts. So let's say you had a call butterfly. So you're long a call, short a call here. So that's like a call debit spread. But then you add another leg to it, short a call, same strike here, long call here. Now this really reduces that risk. So this example, your risk is only $100. And you can see here the spread with the 1,010 and the 1,030 right there. So this would be a $10 wide spread. So here's your target. So right there. So that's a $10 wide spread again. So $1,000. Okay, spread with, but look, your risk is $100. and it's a debit risk, debit cost. That's the max risk. So theoretically, you can make $900 on this trade. All right. So if it was go out perfectly at expiration right there, your short strike, the 10-20 area, this would make $900 on that risk of 100. That's, what is that, a 900% return? So that's typical. Or sometimes you get even bigger returns than that because you're really reducing that risk, but you're also reducing your theta. So that's the kind of the butterfly. Now the condor is another great one. It's kind of like the cousin of the butterfly. So like the butterfly, it also combines buying and selling options. So it combines that vertical debit spread and the vertical credit spread, but it doesn't share the same short strike of the vertical debit spread. So you're widening out the profit zone. So it moves the vertical credit spread short strike further out of the money. So like a butterfly, you know, you're like here, right? You're really tight threading the needle. Well, with the long condor, you're widening that spread out. So instead of selling the same short strike here, like on a butterfly, you're widening that out, which gives you this bigger profit zone. But the spread is also going to reduce your capital at risk, will also give you a positive theta, no time decay. And these are really great for directional swing trades 1 to 2 weeks out typically. So going to give you a really, you know, high return on your capital at risk, really great for hedging as well. So really good favorite there. So here's your kind of a profile of that. So you could do calls or puts, you know. So here we could be long a put, looking for a downside move, short a put, and then we spread that out and short a put, long a put. Okay, so that's the profile. And then we've got this big profit zone in here to take advantage of. Now, the other favorite that I like to use from time to time, it depend, again, these all depend on the market environment you're trading and the you know, the chart pattern or cycle that you're in. So it's what we call the income calendar. So it's a really great medium to longer term non-directional option strategy. So the income calendar is basically a neutral option strategy, but I like to use it directionally, that profits when the underlying security you're trading starts to stagnate maybe or trades within a tight range. So the way it profits, it's kind of like the credit spread. So profit comes from the difference in the rate of premium decay and the implied volatility decay between a near-term short option that you're short and then your long option that you're long is further out in time. So instead of being like a credit spread where, you know, you're short and you're long are in the same series, this puts your short duration near term, closer in to expiration, and then your long part is further out in time. So this makes it profitable because near-term option premiums are going to decay faster than the long-term option premium. All right, so it's really great to use when you're expecting a stock or security you're trading to stay within a kind of stagnant, within a tight range, produces income from the time decay. So also really great to use in market conditions where you want to keep maybe a longer term position intact for, you know, particular stock or even ETF, but you're expecting it to eventually break out either up or down, you know, in a certain direction. But for you know, the shorter term, it's kind of churning sideways and it's not ready to break, but you think over time it will. So this is a great way to get set up for that. So what it does, it allows your position to get paid while you wait for that longer term trend to kick in. So it's also sometimes called a horizontal spread or timing spread. And so, for example, the typical way they're done, these are, you know, using a monthly option, but we can do weeklies as well. So the basic premise is that you go out, let's say here in this example, we sell the $100 strike of XYZ. So we're short that strike there, 30 days out, and then we go 60 days out, further out in time, we buy that as the long dated, okay? So what we're doing is just playing the theta decay. So if it doesn't move, let's just say theoretically it just sits at $100 over the life of this duration of this trade contract. So it just sits there, what happens? Well, that $100 keeps going lower and lower, right? That theta decay. and eventually it goes to zero. So it's going to go to zero before that one goes to zero. So we can take advantage of that spread like that because the time difference between the option series. So that's theoretically how exactly it works. And there are other things you can do with it. I like it great for directional trades from time to time as well. Now, the next one, kind of the offshoot of the calendar, is what we call the calendar diagonal. And this is a real favorite. So it's also medium to longer term directional trades. So think of how many here do covered calls? So if you do covered calls, you know, this will really apply to you because you'll probably understand a lot better. Now, you know, if you do a covered call, basically what you're doing is you're, you know, long shares, right? So you're long, so let's say you're long 100 shares of XYZ at $100. So you're long 100 shares here of XYZ, okay? So what do you do to collect a little rent on that 100 shares? Well, you could sell an out of the money call option against it, maybe sell the 105. You know, this is your shares you bought at $100, now you sell at 105 and you bring in that premium. So as long as it stays below 105, you keep the premium. Now, that's exactly what a calendar diagonal is, except we're not buying the shares, we're buying the option, which is going to be much cheaper. So that's what makes it so fantastic. So this is a lot less risk than doing a covered call. I mean, think of a covered call. In this kind of market we're in currently, if you'd bought 100 shares, 1,000 or 10,000 shares of, you know, whatever Apple, and you've been writing covered calls and then straight down. But if you've been doing this strategy on Apple, not with the shares, but with the options, but with a long dated option, even though it goes down, your risk is defined and capped at a lot less than if you're long 100 shares or 10,000, whatever. You get, hopefully you get the picture there. So it's a medium to longer term directional option strategy that's great for, you know, if you think eventually a market's going to go down or go up, but it might take some time before it actually makes that break. So it's basically like a vertical diagonal debit spread. It's like a debit spread, but with the long option leg expiration further out in time, and your short option leg is set closer to time to take advantage of that theta decay like the calendar. So it takes advantage of short-term weakness or strength that you think will eventually in time revert and cycle either back up if you're doing it with calls or back down. So if you had a trade basis that you think the bias is to the upside, but it could take some time, you could do it using calls. If you think you're going to eventually go down, you could use puts. Okay, so provides time to let the direction kick in. All right, so it's constructed to take advantage again of that accelerated time decay of the front short dated option that's going to decay much faster than that long dated option. So instead of having the shares you're long a long dated option. Now plus the volatility difference. So if you've got a higher implied volatility and you're short dated, you're getting a higher premium than you're long dated. So that's another thing that takes advantage of. Plus the big advantage, one of the key advantages is that additional vertical spread component. So that adds a really great directional component for greater profitability. Okay. So again, this is like buying at a discount. So if you say XYZ, you bought it here and it's at $50, but the market's come down real hard and you think it's starting to turn, but it's going to take some time, but you're pretty convinced that direction is going to kick back up. Great strategy, because we can just buy the long dated here, sell options against it, keep rolling those options, and eventually when it kicks up, we bought that original option at a discount. So really one of our favorites at Power Cycle Trading. So think about this, looks kind of like a call debit spread, or you can do puts. So let's say you just did a call debit spread. It looks like that. So you're long call, short call, but that's in the same option series. So let's say this is a June monthly or something like that. Now what this would do is, instead of having you're going to have different series, okay? So your long dated would be maybe out here, you're out in July. Now we can use weeklies too, but the short dated is in June, okay? So we're maybe long the 100 out here in July and then short the 105 in June. So we get that added benefit of that theta decay. So kind of like debit spread, but we're different option series to take advantage of more accelerated theta decay on the short strike. So really great trading advantage there. So let's take a look at a couple examples to kind of clarify these structures. So we're going to look at vertical debit spread, butterfly, the condor, and calendar diagonal. So we're going to look at, this was one, these are trade setups that we did in our, I have alert service that sends out these trades when I see a good setup. So these are alert trades that were sent out to give you an idea. So this is going to be just a put debit spread. So we're looking for a downside move, and this was on QQQ. So going to be defined risk, great for hedging, great for swing trade kind of time frame, great for breakouts and reversals. 1 to a month out, something like that, or you can go further than if you want. It's going to have, it won't have a positive theta, but it's going to have a lower theta than if you just went long calls or puts. And your returns on this are typically, 1.5 to 3 times your capital at risk. So this is what, just to look, I won't go through the details, but this was the alert sent out. This was back in May 11th, and it was traded at 298.30. And then we ended up taking profit. We did this, started out as a day trade, and then took profit the same day and the next day. So here's the trade setup. It says new QQQ short, trade at 298, etc. Market oversold. So we're going to be careful on our short. This is a short-term day trade. May hold longer depending on today's price action. Short trade buy, and it says here what to buy. The 13 May 298, 290 put at around 295 will convert to a butterfly. See here, this where we're going to adjust this to butterfly on any move lower to reduce our risk. Okay, so here that was the initial sent out alert. It was trading right here, so just kind of to back into what it looked like at the time. So it was trading right here at 298, and we were looking for a move down. I like to use Fibonacci's and moving averages for targets. So when it moved down here, it moved down to close to our target. This is where we started taking, well, we took profit the first day. It was a day trade to begin with. And then we took profits here. And then we also made an adjustment, which I'll show you, and then took the balance of the profit there. So that's what the chart looked like, going into the trade. So here was the trade setup. So originally the original debit spread. So we bought here in this trade, we bought the 298 put right there, 13 May, and these are weeklies, and sold against it the 290, so $8 wide spread. You can see that. And so it went from 280 was our cost of the trade, so it went from 280, and then when we took it off, in this example, it was up to 197. So that was a 70% return, and that was the same day. So we set this up, it's traded at 298, and the same day, now it was trading at 291. So within that 1 day span, this was up $197 or 70% return, versus if you're trading what futures or stock outright on the shares, you would not make anything close to that kind of return. So that is a look there. And then we let it run for another day, and the next day it was down even more. So the next day it was down to 286. And so at that point, we were up. It went from now, we set this up at 280. Now it was up to 626. So now this trade was up to $346 per spread on our risk of 280. So we had now 124% return. So really, great trade structure. Like to use these for what we call a kind of a breakout, where we get a good fast move to the upside or downside. This was for a breakout down, which worked perfectly. So that's a great example of a put demonstrated when to use it in that kind of market cycle or environment. So here's the profile of it to show you exactly what you had at risk on the trade. So your potential max loss was 280. So you've got a defined risk trade of 280. Your max potential profit at expiration, if it closed below your put short strike here of 290, you'd make $520 would be your max. So potential for 186% return on your capital at risk on that trade setup, the debit spread. Now let's see if I can get this to turn. So the next one is a directional short, again on QQQ. This is just the adjustment that we did on that put debit spread, and we adjusted it into a wide wing butterfly spread. So we created an wide or $800 wide butterfly spread to increase our potential profit if it runs further. And also, this reduced our risk to let us stay in the trade for a longer period of time. Plus, we get a bigger positive theta. So it's going to give us a better, wider profit zone, great defined risk, great for hedging, great for targeted swing trades, great for what we call pinning trades, great for high volatility markets, great for, typically a day trade, maybe up to 2 weeks is about as far out as I'd go. Positive theta, no time decay, returns of 2x up to 10x or higher. So you can get up to 1,000, sometimes even greater returns than that. So here was the trade. So we originally, this was backing up into that original trade was set up as the debit spread. So we had trade one was the debit spread. And okay, so we had that, the original setup, the 298 put short the 290. And let me get this pointer a little bit better. Okay, so that was the original trade. That cost $280. Now, when the market went down, we adjusted the trade by selling a short bull credit spread. We sold the 13 May 290, so we shared the same short strike as the put debit spread there, and then bought below that the 282, so $8 wide. So balance, we had $8 on the debit spread, $8 on the debit spread, and we had now $8 on this credit spread. And this, when we did that, brought in $2.58. So look, 280 minus 258. Now we had a spread cost of $22. That was our max risk. So our risk was reduced from $280 to $22. And now we have still potential for huge returns on this trade. So theoretically, this trade now is adjusted to a trade where we're risking 22, and if it went out at expiration at 290 exactly, this would be up $778 on that risk of 22. That's a 3,500% return. All right, so this was an alert trade. It shows you here, the setup. So that's the cool thing about it. These are pretty exciting when you get these things working for you right. So here's the initial trade right here on the put debit spread. It dropped down here at that point when it was trading at 291. We adjusted the balance of it into this put butterfly, and now had only $22 of risk in the trade. All right, so again, just kind of step through it real quick. So we're initially long the 298 put, short the 290. So there was our put debit spread right there. And then when it dropped down hard, we sold the 290 right here again, bought the 282 to cap that risk. So we're capped risk trade, okay? So short. All right, so $8 on both sides of the spread, so $8. Now our risk was knocked down at 22 bucks per spread, which theoretically, if it closed perfectly at the top of that, a butterfly, we'd make 778. Now it's theoretical because I've never had a time where it ever was perfect, okay? But look at the potential return. So even if you make a small fraction of that, you've got a great return. So you're basically risking $1 to make 35 in that situation. So here's your max loss after the adjustment, $22, max potential profit. And this was a put butterfly that it was adjusted into on that trade. And so here's what it looks like going out. So this was on the 12th, went ahead and took profit because it was starting to look like it might push back up. So we had exited the balance of the trade, and at that point in time, it went from $22 where we adjusted it to, now it was up to, it was trading right here at $291.15. So it was up to $286 on that spread. All right, so that gave us a profit of $264 on the balance of the trade. And at that point, look at that, 1,200% return. All right, so that's I mean, these are what you can actually do with this type of structure. So that's the butterfly. Now the next one is what we call the counter diagonal. This is another really favorite. Now this one is on the ETF, the Russell IWM, and this was a short trade. So we set this trade up thinking, okay, IWM is going to go down. We're not exactly sure how long it might be today. It could be though a week. So we want to structure it to give us enough time for this to work out. All right, so again, it's going to be defined risk, selling time volatility, directional target trade used for income while you wait, getting paid while you wait. Again, also sometimes called the poor man's covered call. So that we go out on these 1 week to a month out, or even longer. You can do these using, your leaps if you want for calls or something. Positive theta, no time decay. Now this one was a short trade because we were looking at the Russell to break down, but weren't sure exactly when it would be. So this was again the alert trade. So you can kind of see here it says IWM short was traded at 205.40 by diagonal. So this was going out buying the 18 April 205 call and then selling against it the 8 April. So short duration there, right, at 265 or around there. So it was trading up here. See this when I like to use this one is again, the market had moved up and it was starting to turn over, but it could have, just maybe churned here. So we weren't sure. We didn't know it was going to go straight down. So we thought it could churn. So we wanted to give ourselves enough time on this trade. So it was set here when it was trading at 205 right in here. And then we were thinking, okay, it could churn, but eventually it's going to go down. But this worked out great because it went straight down. But that's the kind of the basis of the trade. And we did a couple adjustments on this and really adjusted this really down to very little. Okay, so here's what it looked like. That's what the curve looks like on the trade. And again, on this one, we did a couple of adjustments. So we got the cost of the trade. We amortized it down to very little. When we ended up amortizing this down to $73. So we amortized it down to 73 and we had a return here. Now it went from 73, the spread was at 73, and when we closed it out, that spread was at 462. Okay, so that's a $389 per spread return on that risk amortized down to 73. That was over a 500% return there. So just a lot of different things you can do once you understand the option strategies available, when to use them, and then how to use them. So that's kind of what I put together this option guide. Now, today is just a start for you because I was only able, kind of scratch the surface. There's so much more to it than what I can present, but you can get the kind of the basis of it here from this presentation this afternoon. So let's take a look at the steps you can take now if you'd like to start mastering these kind of fantastic trading benefits of these option spreads. So I did a course and I just completed this in May, okay, just less than a month ago. And this course was my Ultimate Option Guide course, when and how to use which strategy for the best results. So this course was live, and I had it recorded. It's broken down now, 30-minute modules or less, and now it's on demand. But I'm going to make it available for everybody here today if you'd like to jump into the course. If you look at my website, this course is available at $597. But today I'm going to give everybody here, if you'd like, this course plus 5 enrollment bonuses for $197. So to get this special price, let me give you the link. So just use this link. You can see it right here. It says powercycletrading.com/expo, EXPO. Here's the link though. I'll just copy it and paste it, and you can click on it. And then I'll go through and show you what the course is all about and your bonuses that if you'd like to take advantage of it. So use this link here, right there. And let me make sure. So click on that. And yeah, good, that works there. Okay, so here's your payment link here, Ultimate Option Guide course. Now this is a fantastic price. I'll show you here it is currently on my website, but I'm giving everybody here a great discount. So go to courses, go to Power Cycle Trading courses, click on trading courses, and then you'll see here, here's the course right here. It's the Ultimate Option Guide, when and how to use which strategy for the best results. So just completed this in May. So this will tell you more about it, but this is the price on my website. So it's right here, $597. So that's without all these bonuses as well. So really good. I think it's a very, very good offer for any of you here that are just starting out with options or more advanced and just need more clarification. So with this course, $197, you're going to get these additional bonuses. So here's the link again, Charlie, right there. So use that link. Okay, so you're going to get the recorded. This course ended up about 7-8 hours with the Q&A and everything we did it. So you'll get the 6+ hour recorded course. You're going to get a follow-up support live and recorded Q&A. We'll do this in probably, I'll send out an email to you probably a week, maybe 2 weeks out. Give yourself a chance to go through the course. Then you'll be invited to a live Q&A, which then you can ask whatever questions you have regarding the course or anything else at the time. Plus, I'm going to give you a 30-day trial membership to my Power Cycle Trading Club. So this is going to give you, I'll go through with the benefits of that. And this, if you continue on, it's $97 a month, but you'll get one free trial month now. Then I'll give you bonus 3 is what I call it's a video course on how the pros use the Greeks. So it's a course on the Greeks with videos and PowerPoint on that. My complete option strategy guide. This is 15 other different option strategy, option strategies explained how to use them or when to use them. So you'll get that, and then you'll get my Greek power tool guide, which you get. It's a printout on the Greeks you can put on your desktop. So you'll get all that for $197. And with the if you do this, your trading club is a 30-day trial. You can start this whenever you want. So if you don't want to start today after you buy the course, but if you want to start it in a week or 2 weeks, whatever, just send us an email. We'll do that for you. All right. So that's what you get for your $197. And then the course, I'd like to start out with the foundation of your option trading so you understand the edge from the Greeks that you get with these strategies. So we'll go through the option Greeks and how to use them for your trading edge for these various strategies. Again, how more in depth about how option pricing works, standard deviation, more on option delta and the trade probabilities, and then how, why, and when to take advantage of volatility and volatility skew, what that is and how to take advantage of it. Then we get into the option strategy guide itself. So this is a process I put together for selecting which strategy to use and when, based on the market cycle you're trading, up, down, sideways, market environment, are we in really high uncertainty, low, etc. What is your degree of uncertainty? And based on my 5 chart patterns that I identify and use. So we'll go through all those for setting up the guide as to, okay, what strategy should I be using in this certain situation of the market based on these components. So then we'll look at what is the best option selling strategies to use, what are they and how to use them, what's the best buying option strategies, what they are and how to use them. We'll go into more depth to the option butterfly, which is just simply amazing to take advantage of the high volatility markets like we're in now. Okay, so we'll go through that. So this strategy can give you returns of 100,000% or more, as you just saw from that example. Really amazing strategy. And then the market major trading advantages, we'll go through the long option condor spread, how to use that and when to use it. So it's actually my first step for hedging. Okay, so we'll go through what that is, and then how, why, and when to use that long condor spread for your directional trading. So then we'll get into the calendar spread in more greater detail. So timing income strategy, when and how to use it. And one of my very, very favorites is the calendar diagonal right here. So when and how to use it. Okay, how the calendar diagonal works to create that market neutral directional trade for income and potential really big returns on market direction. How the strategy works based on getting that time decay without completely sacrificing direction. How do you structure it, with the difference in implied volatility, what we call skew. We'll go through what that is and how that works, and then how, why, and when to use. So super great strategy. So this course really covers the strategies for the different market environment, which is really crucial for your longer term trading performance. So then we get into the favorite go-to strategies. We'll go into detail on when and how to use all these for buying and selling options, vertical debit spreads using calls and puts, butterfly, the long condor, calendar, and calendar diagonal. So these are all covered in the course with really good trading examples to show you exactly how they work. How, why, and when to hedge. So this course has a really good hedging component to the course. Progressions of hedging using these various option strategies, and then risk management, how to adjust and reduce position risk using your options. Okay, and then I go through and show you how to be looking for a trade to convert to either a free trade or a very low risk trade, so such as that, put debit spread converted to that low risk butterfly. And a lot of times we can get this to zero risk or even get a credit from doing it. And then a chapter on assignment risk, expiration, and trading library. So really extensive, great course. So I want to put this in. This was from Pam, one of my members. I just got this about a week ago. She sent me this email and said, just send a quick note of thanks that you could maybe pass along to Larry for all of his fabulous teaching through the years. I truly have enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world. Thanks, Pam, if you're here, when it comes to option spreads and other ways to do trades than Larry. Okay, so your bonuses, again, here's that link for you. And again, here's all the good extras you get. The Ultimate Option Guide Workshop. So you'll get also bonus one, my live and recorded follow-up accountability support Q&A. So that will be a follow-up. We'll send you a link on that. Plus, you're going to get 30-day trial membership that you can start anytime you want to take advantage of our trading room. So then you get the trading room access for 30 days. And this is a really great way for you to get support on any trades, anything that you're currently doing, and you need to ask a question, you come in. I'm open in the trading room where I'm there every morning, 9:30 to 10:30 Eastern, Monday through Friday. So with this trading club, you'll also get to do a video updated newsletter every night after the close on what the market's doing, what to expect the next day, what trades we're looking at. Our trades are video and archived. We do a live Q&A every Tuesday, and that's also recorded and archived. And then there's a trader educational vault for free, really good content for everybody that's a member of the club. And anything on my website, Power Circle Trading, you get a 60% discount on all courses and software. So just wanted to say my option knowledge has leaped exponentially since joining your trading room. And this is really so true. Reading books is fine, but seeing the actual trade setups makes a huge difference. Again, thanks, Jay. So a little nice feedback there from one of my members. And then you're going to get bonus three, how the pros use the Greeks to make money, the tutorial. So this is a 60-page option guide with videos, just more concentrated on the Greeks, delta, gamma, theta, etc., pricing options, market maker secrets, standard deviation, option delta. So this bonus package will really cover a lot of your option needs, and this one course here will be something that you can use forever. And it's one of my most popular courses because I've had so many members and clients that I've worked with that there's so many different option strategies, you're not sure which to use. So I wanted a course designed to kind of clarify that and teach in an easy way of how you can select the best option strategy for the environment you're trading. So that's what the course is all about. And then you bonus for my 15 top option strategy guide. So it'll tell you, what is a back ratio spread, when to use that, straddle, strangle, things like that. So that's another bonus. And then this is a PowerPoint you can print out, put on your desktop. What are the Greeks, gamma, theta, gamma, things like that. So a lot of great content here. And again, if you look at my website, you can see the price there. But the other great thing is that didn't really stick on was you get discounts on any other courses I have on my website. So if you look here, I'll just pull it back up again here. You go to my website, you'll get 30-day trial. And if you want to stay on with the club, you stay on, and it's $97 a month. But if you want my trading software, you go to trading software. I've got all kinds of different indicators and scanners and stuff. These are my trading indicators. So you'll have access to any of these indicators, these tools here, for the price less 60% discount. So if you wanted my core model, my custom trading indicators here, got them for Thinkorswim, TradeStation, eSignals, Ninja Trader, TradingView, and Wealth Charts. You can get these, and you'll get it for 60% discount. So the indicators here, you can see 597. You'll go here, and if you want them, you'll get a discount. You put your membership code in here, and it'll drop it down by 60%. So you get big discounts on all my indicators. get discounts on any of my other trading courses. I've got option trading courses pretty much covering everything that you could think of. Earnings, you've got selling options, butterflies, just whatever you need help on. That's my thing that I do. So just a lot of great content and a lot of great material. So hopefully everybody here got some things from this presentation, and please do join us. I'd sure like to have you join us at the Trading Club and for future courses or anything else. But this will be a great kind of go-to course for you. Probably help you with a lot of the different things that you have been having troubles with. So any specific questions right now? If not, we can call it a day. I'll show you real quickly. Now, yeah, somebody asked about the Trading Club. If you did want to join my alert service, if you want to join my alert service by chance, if you want to, just send me an email at support. So if you buy this package tonight at $197, you get all the bonuses and everything. And what I'll do for you, if you'd like, you can also, if you'd like to be part of my alert service, which I have 4 different alert services, you'll get all that. And so it's $897. What I've been doing typically is $897. And for the $897, you'll get my 4 trading alert services. Okay, there are 4 different ones. Service I send out: calendar, counter diagonals, butterflies, condors, earnings trades, and debit spreads. Okay, so 4 different services. Plus, you'll get my Trading Club membership for giving people 7 months. Okay, so if you want that, you need to purchase tonight at $197. Then if you want to change over, think about it, whatever, then we'll change over and I'll knock off the $197, so you just pay the difference. Okay, so if you wanted to upgrade, you can do that. I don't offer my alert service on the on my website, but a lot of times I'll package it in when I do courses. So I just want to throw that out if you're interested. So you could upgrade for $700. So that's pretty much everything. Yeah, here's one trade we did this is what's great about calendar diagonal. This is one that we did on GLD, and we adjusted this. We've been in this trade for a few weeks, but we've adjusted this down. We converted it to calendar, and now today it went positive, it went profit. We were down on this trade, and we kept adjusting it, and now we're up on it. So it's a really cool strategy. All right, so I hope that was good content and entertaining to everybody, and look forward to working with everybody here in the future. So again, thanks everybody. Any last minute questions? Okay, here's the link one more time. I want to make sure I've got it here. There you go. All right, good luck trading tomorrow, and hope to see a lot of you in my trading room once you sign up for the course. Thanks again. Ciao.